Walgreens stock, ticker symbol WBA. Today they announced quarterly results and the stock is down roughly 3% as of recording this video, although they beat in both EPS and revenue. So, is this the perfect time to buy Walgreens stock? In this video I'm going to show what Walgreens does, a quick view at the historical stock price performance, the fundamental analysis, the dividends, their major competitors, and in the last part I'm giving you my price target to see if Walgreens is a buy or not. I'm very excited to see what you guys think about the stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and to receive multiple analysis every week, where I will tell you everything you need to know about the stock market. So, what does WBA do? Walgreens Boots Alliance is the leading retail pharmacy chain with about 13,000 stores in the US and internationally. Walgreens' core strategy involves brick-and-mortar retail pharmacy locations in high-traffic areas, with nearly 80% of the US population living within 5 miles of a store. I want to take a quick look at the quarterly report they just released. First thing is growing the core business. US retail comparable sales are up 1.4% or 2.4% excluding tobacco. US digital sales are up 25% and they grew their My Walgreens members to over 99 million, which is quite a lot. In the UK, retail comparable sales grew 24%, with market share gain across all major categories. Although they beat the EPS consensus, it's down roughly 29% versus last year. The performance is broadly in line with expectations and they're maintaining the full year 2022 outlook of low single-digit growth. When we check the revenue breakdown by location, we see that there are two segments, US and international. The US sales represent roughly 83% and the international sales represent roughly 70%. We also see that operating margins are lower in the US versus international. The last thing that I want to show is the market share of pharmacies in the US. CVS is the current market leader and Walgreens is in the second spot. They are by far both the biggest companies in the US. And now that we know more about the company Walgreens, it's time to check the historical stock price performance to see what happened in the most recent periods. I'm also including the S&P 500, CVS and Cigna. Let's start with the 5-year chart including dividends. WBA is down roughly 38% while the S&P 500 is up 72%. CVS is up 33% and CI is up 64%, so all stocks underperformed the S&P 500 in the past 5 years. On the 1-year chart we see that WBA is down 18%, which is twice the amount of the S&P 500, which is down 9.7%. CVS and CI are both up around 15%. On the 6-month chart we see that all stocks are down, besides CI, which is up 16%. WBA is down 22%, the S&P is down roughly 20% and CVS is down 9%. On the 1-month chart we see that Walgreens is down almost 10%. The S&P 500 is down 8% and CVS and CI were the best performance of these 4 stocks. So with today's earnings release, it doesn't look that good for Walgreens. This stock is down roughly 3% as of recording this video. But does this mean Walgreens could enter an interesting buying area? Let's find out with checking the fundamentals of this stock. Walgreens is a 35 billion market cap company with a 12 trailing month revenue of 135 billion, which is quite odd comparing to the market cap. In this graph we see the revenue over the past couple of years. It's going up and down quite a lot and is not really consistent, but in the most recent years it's a bit more consistent. Net income is at 6.29 billion, which gives us a 4.6% profit margin. The 5-year average profit margin is at 2.9%. In this graph we see that in the lockdown periods the margins went down quite a lot. But profit margin is up again, which is a good thing. The gross margins are decreasing since 2013, so keep an eye on that number. The current PE ratio is sitting at 5.5, which is really low. The 5-year average is sitting at 9.5 and is also very low. Return on assets is sitting at only 5%, which is quite low. Return on equity is at 25% and looks all good to me. The return on invested capital looks also a bit low with only 5.8%. The 5-year average is slightly higher at 7.6%. You want to keep these numbers all above the 10% minimum, so make sure to keep an eye on those numbers as well. The next thing I want to check is the balance sheet. Walgreens has an operating cash flow of 5 billion and leverage free cash flow of 7.8 billion. The total debt is sitting at 38 billion, which is quite a lot compared to the free cash flow. So they are not capable of paying down a big chunk of the total debt. And for me, this could be a problem. It's okay to use debt to grow the business, but you always want to have it at a healthy position. Especially since you want them also to use this cash flow in other parts of the business, like buying back shares or paying dividends, for example. In this graph we see that free cash flow is going up and down quite a lot. But since 2019 is growing nice and steady. You want to keep an eye on the free cash flow growth, because this is very important for this company. The thing I like about Walgreens are the shares outstanding. You want them to buy back shares so the EPS goes up and it's more easier to maintain the dividends and of course increasing them, since less dividends are paid. In this graph we see that there are two different periods, from 2010 to 2016 and from 2016 to 2022. In the first period, Walgreens doesn't bought back a lot of shares, and it's not consistently. But in the most recent years they did. So this is a good thing. In the past 5 years, Walgreens bought back roughly 20% of the total shares outstanding, which is quite a lot. Next up are the dividends. Walgreens has a 4.6% dividend yield and an annual payout of $1.91 a share, or 48 cents a quarter. Payout ratio sits at only 32%, which means they have 68% left in cash to buy back shares, pay down debt and all other things. With the dividend yield already sitting at 4.6% and payout ratio very low compared to the yield, I think it's not that important to have a 5-year dividend growth rate at a high level. As long as it's growing, it's all good. So 4.95% growth rate is fine by me. You want them to pay down debt and buy back shares with the 68% free cash flow that's left. Walgreens grew the dividends for 7 years in a row. The next thing I want to discuss are the fundamentals of Walgreens versus the major competitors. Again, I decided to include CVS and Cigna. All companies have a very low PE ratio, so this tells something about the industry. When checking the revenue growth, we see that all companies have an 8 to 10% revenue growth year over year. But CVS and CI have a both higher revenue compound annual growth rate. Walgreens is sitting at only 3%. Net income is also growing a bit better at CI versus Walgreens. But the free cash flow is growing at a much higher rate at Walgreens, so that's very nice. Next up is the profitability. Walgreens has the highest margins of all companies in this list, and also the highest return on equity. Return on assets is pretty similar with all companies, and return on total capital is the lowest at Walgreens. The last thing I want to show are the dividends. Walgreens has by far the highest dividend yield and also the highest payout ratio. Walgreens and CVS have similar dividend growth, but CI has by far the highest dividend growth. The last part of this video is about the price target. I'm using the Everything Money software, which is one of the best tools to use in my opinion, so make sure to check it out. We have 3 price targets, a low assumption, a mid assumption and a high assumption. I filled in all these numbers based on what I found about this company. So I think revenue will be growing a bit slow, which is confirmed by the 5 and 10 year average. Profit margin will also be at current levels, I think. And it's the same story with the free cash flow margins. Since this is a slow growing company with a lot of debt, you don't want to overpay. So I'm using a low PE ratio and also a low price to free cash flow ratio. My desired annual return is at 12.5% because you can get an easy 10% average return with the S&P 500 ETF over a longer period of time. When I hit analyze, we see that based on my assumptions, Walgreens is a buy, even with my low assumptions. To be honest, the high assumptions don't look really justified to me. So I think it would be realistic to have a low to mid assumption. My final conclusion on the stock is that it could be an interesting stock to buy. It's a steady dividend stock with pretty decent fundamentals, except for the high amount of debt. But since the free cash flow is growing again, I think this doesn't have to be a deal breaker on this stock. Based on the price targets and the current dividend yield, I'm adding this stock to my watch list because I want a higher margin of safety and I do think there are better deals in the market right now. But remember to always do your own research and never fully trust what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.